Hello, welcome to the Credit Compass, your guide to navigating European credit markets. Each week, we unpack key developments in credit, explore the macroeconomic forces shaping the landscape, and dive into the strategies that matter most for investors across Europe and the UK. Summer 2025 is rapidly turning into the season of fiscal recalibration, from Whitehall to the Elysee and even in the factory floors of Munich. Policymakers and corporations are asking the same question. How do we fund growth without fraying the public purse? Today, we'll cover three key stories. First, the UK's widening deficit and the Chancellor's Leeds reforms. Second, France's headline-grabbing plan to scrap two public holidays and the political backlash. And third, Germany's multi-billion Made for Germany investment pledge and why it could be more than a PR splash. We'll finish with a pulse check from the IACPM's Global Credit Outlook survey and consider what all this means for fixed income markets. All right, let's set sail. Let's start in the UK, where Chancellor Rachel Reeves is facing immediate fiscal pressure. Public sector net borrowing came in at $20.7 billion in June, well above the $17.5 billion economists had forecast. Higher interest expenses played a leading role, particularly on index-linked gilts, where inflation-linked liabilities continue to weigh heavily. But another quieter factor is quantitative tightening. The Bank of England is actively unwinding its 800 billion sterling balance sheet, with roughly 620 billion in gilts still on the books. As the bank sells those bonds, often at prices below purchase levels, the Treasury must compensate for losses via transfers. That's in addition to its own primary issuance needs to fund the deficit. The result is a kind of double dipping in supply pressure. The bank is a seller and the government is also an issuer, both hitting the same market. There's now growing debate about whether the bank should revise its strategy. One suggestion that's gaining traction, inspired by the Bank of Canada, would involve slowing sales of longer-dated bonds and instead running off shorter maturities as they mature or selling those that are closer to par. By holding long-duration bonds to maturity and capturing the yield spread versus their low-cost liabilities, the bank could reduce the need for fiscal backstops, easing the burden on the exchequer while still delivering on monetary objectives. Now, that's the backdrop. Let's pivot to the Chancellor's Mansion House speech last week, where she laid out what's being called the Leeds reforms, a comprehensive policy package aimed at reinvigorating the city, unblocking domestic capital, and sharpening the UK's regulatory edge. The speech outlined four key reform pillars. First, a rollback of regulatory overreach, particularly where post-crisis safeguards have been deemed excessive or duplicative. This includes revisiting the role and scope of the Financial Ombudsman Service, softening certain ESG reporting mandates tied to the UK's green taxonomy, and refining the accountability frameworks of the FCA and the PRA to reduce friction for regulated entities. Second is a renewed focus on the UK's competitive strengths. Specific measures including new captive insurance rules to better accommodate international reinsurers, a reform regime for UK domiciled asset managers set for release in 2026, and a dedicated scale-up unit within the FCA and PRA to support growth stage fintechs. A new concierge service for inbound investment, especially for global firms considering UK expansion, is also in development. Thirdly, changes to capital requirements to free up lending capacity. This involves lifting the minimum requirements for own funds and eligible liabilities, or MREL, thresholds for smaller banks, focusing the most stringent requirements on systemic institutions. The Chancellor also committed to finalizing Basel III implementation in a way that reduces capital burdens for domestically focused lenders. And importantly, there will be a review of the UK's ring-fencing regime, still one of the most rigid globally, to ensure it remains fit for purpose. And lastly, reforms aimed at encouraging more risk-taking from retail savers. A simplified and more flexible ISA framework is coming with the intention to allow multiple accounts, broader eligible assets, and a higher overall contribution cap. The goal is to nudge households to allocate more capital into long-term equity and credit instruments rather than sitting in cash. Taken together, these measures send a positive pro-growth signal. They target supply-side frictions in both the banking system and capital markets, and aim to position London as a more agile financial centre in a post-Brexit environment. That said, implementation will take time, and the near-term economic picture remains challenged. Consumer sentiment is still fragile, real wage growth remains uneven, and corporate credit demand has yet to pick up meaningfully. But directionally, these reforms lay the groundwork for more efficient intermediation and better domestic capital formation. Across the Channel, France is wrestling with its own fiscal constraints, albeit through a different lens. Prime Minister François Bayrou unveiled a controversial draft budget last week aimed at reducing France's deficit to below 4% of GDP. The headline grabber is a proposal to eliminate 2 public holidays, reportedly Easter Monday and May 8th, as part of a broader effort to improve national productivity. The political reaction has been fierce. Labor unions immediately called for demonstrations, and several opposition leaders accused Bayrou of ideological austerity. Yet, for all the theatrics, the underlying math is serious. France's debt is approaching 110% of GDP, and EU pressures to bring deficits back in line is mounting. Cutting 2 bank holidays could boost output by an estimated $4 billion a year. Really a drop in the bucket in comparison to the budget deficit, but a highly visible one. Whether this is an opening negotiation gambit or a genuine policy intention remains to be seen, but the government is clearly signaling a willingness to confront sacred cows in the name of fiscal repair. From a market perspective, OAT bond spreads have widened slightly in response to the uncertainty. If a credible budget compromise emerges, those spreads could tighten, but until then, expect continued volatility in French sovereigns. Meanwhile, in Germany, we're seeing a more optimistic picture, especially on the investment front. A coalition of more than 60 major corporations, including Siemens, BASF, Bayer, Commerzbank, Deutsche Telekom, SAP, BMW, Mercedes, and VW, have all pledged over $100 billion in new domestic capital investment through 2028. The initiative, dubbed Made for Germany, is being positioned as a strategic recommitment to the country's industrial future. Unlike prior cycles where German corporates led with exports and cautious balance sheets, this campaign is explicitly aimed at domestic reinvestment. The Merz government is fully on board, rolling out measures to accelerate permitting, trim bureaucratic overhead, and reduce corporate tax burdens. While some critics argue that much of the pledged spending was already in the pipeline, the political packaging matters. This is a high-visibility, pro-growth message at a time when Germany has been flirting with stagnation. What's more, this private sector momentum complements the government's $500 billion stimulus program focused on infrastructure and defense. That program will take time to feed through into GDP, but the corporate capital being deployed now could bridge the gap. Early indicators like the latest IFO and PMI readings suggest a modest turnaround is already underway. All of this feeds into the broader credit outlook, and that brings us to the latest quarterly survey from the International Association of Credit Portfolio Managers, or the IACPM. This survey polls senior risk managers across global banks, insurers, and asset managers to gauge their expectations for credit defaults and rating migration. In the most recent release, sentiment in Europe improved markedly. The index tracking expected corporate default rates in Europe rose from -64 to -37, marking the largest quarter-on-quarter improvement since mid-2020. That's still a negative number, indicating more defaults are expected, but the pace of deterioration appears to be slowing, and that's important. The improvement was broad-based, but particularly strong among respondents covering industrials, infrastructure, and utilities, sectors that stand to benefit from the policy and investment tailwinds we've outlined. Conversely, concerns remain elevated in commercial real estate, discretionary retail, and smaller leveraged corporates where refinancing pressures haven't let up. North America, on the other hand, saw a deterioration in sentiment. The region's index fell from -60 to -65, with particular concern around Canada. The looming threat of new U.S. tariffs potentially targeting autos and industrial components has spooked risk managers, especially those with exposure to cross-border supply chains. Canada was singled out by more than a third of respondents as facing above-average risk. Importantly, very few respondents globally expect default rates to fall in the near term. What's shifting is the balance between worse and unchanged. A growing share of credit managers now anticipate that conditions will stabilize rather than continue deteriorating, and that's a meaningful shift in tone. So what does all of this mean for investors? Well, we remain constructive on European credit, particularly investment-grade fixed income. Yields remain elevated, providing attractive carry, and the macro data is starting to firm up. Germany's corporate reinvestment push is a clear signal of confidence, while the UK's policy environment is becoming incrementally more supportive of capital formation. At the same time, risks do remain. Political uncertainty in France, fiscal headwinds in the UK, and unresolved trade tensions all present downside scenarios. The 1st of August deadline for EU-US trade talks looms large still. If tariffs are imposed, it could weigh heavily on European auto names and widen spreads. But overall, the tailwinds are building. For fixed income investors, the message is stay vigilant, stay diversified, and use these moments to reposition with care. That's all for this edition of the Credit Compass. If you found value in today's episode, please follow, rate, and share it with your network. Questions or topic ideas? Well, get in touch. We'd love to hear from you. And for deeper research and credit ratings, please visit us at KBRA.com. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.